Hello, everyone, and welcome to yet another episode of Grow Your Wealth, a series brought to you by BQ Prime and powered by Grow, the investing platform that's fast, easy, and convenient. Now, Indians are investing in financial markets in a larger fashion and size. We're looking beyond the traditional investment products like fixed deposits and mutual funds. And that's the reason why we, on these episodes of Grow Your Wealth, want to empower Indians in making the right investing decisions. We want to help Indians in choosing the right stocks and taking decisions when it comes to buying, holding, or selling stocks. With that aim in mind, on this episode of Grow Your Wealth, we'll be taking another deep dive into fundamental analysis and discussing a very important topic that we believe is something that every investor should know: the money mistakes that one must avoid and the top 10 behavioral traps to avoid. To talk about this topic, we have with us today Avinash Goraksha. He's a finance professional covering fundamental research and having enjoyed an extensive work experience of more than 30 years within the Indian financial services sector. And he started his career in 1992. He is currently the head of research at Profit Mart Securities. Avinash, thank you so much for joining in. Well, Avinash, you've been working in this field. You have had a vast array of clients in these last 30 years. So, in your experience, what are the most common money mistakes clients tend to make?
I think, Mubina, the first mistake which most of the clients make is that there is a complete lack of patience and conviction. I think when you get into the equity markets, you must understand that you must have 100% conviction and patience, because that's the only way to make long-term wealth creation. That is point number one, and the first mistake which most investors commit. The second important mistake is, the fear of missing out. Whenever the market rallies significantly, it goes up very fast. There are many investors who feel that they have missed the bus. So the fear of missing actually makes them buy stocks at astronomically high valuation levels, and then they end up in losses. So I think the second mistake is the fear of losing, which makes them take wrong kind of investment decisions. And thirdly, as I mentioned to you, that they always try to copy the portfolio of their friend or maybe a celebrity investor and try to see whether they can outperform the markets. See, you need to do a little bit of original research, and you need to do a little bit of reading about the company you need to invest. And once you do this basic kind of research, you are well equipped to actually identify any company on your own which can actually generate a good alpha for you. The most important aspect is that you need to get into a good quality company, a good business, and obviously, having reasonably good operating metrics as far as the ROE, the return on equity, cash flows are concerned. And most importantly, several people try to build wealth by trading, by using the derivative option data, by using a futures kind of instrument for building wealth creation. Now, this is absolutely wrong. If you want to build wealth and if you want to really genuinely make a huge amount of capital, then fundamental analysis is the only way you can make wealth. So don't mix trading and investment. If you are a trader, you should have a separate account, do trading there, but don't mix the investment call with the trading calls, which is basically what happens with most of the retail investors. And finally, believe in data. Basically, people always go on market rumors, they go on tips, they go on what the broker says, they go on say what the friend is saying. I would believe that, don't believe anybody at face value in this market or in any market. I think the most important aspect is that you got to get your facts and figures properly in check and then take a logical call. So don't take any decisions based on somebody's bias. Take it purely on the data and on the logic coming out of their data. And I think, these are the kind of mistakes which most of the investors have committed, and they still continue to commit. So I think, if you take care of these mistakes, almost 70 to 80% of your problems are completely done and your investment journey can be very profitable.
All right. So these are some of the mistakes that people and investors tend to make. What about behavioral traps, as we call as biases that humans inherently have present within them? What are some of the behavioral traps that prevent people from making the right investment decisions?
See, I think, Mubina, I think behavioral aspect is very important because emotional, well-being in the market is very important. If you are a weak emotional person, then I think making money in the markets is extremely difficult. The kind of volatility which we see in the markets today is very large, and therefore you require a lot of conviction and emotional balance when you take investment calls. Most importantly, you mentioned about biases on any particular asset class. There are many investors who prefer that they would invest only in debt instruments. They would only invest in gold. They don't like equity because equity for them is a risky asset class. But there are positives and negatives for every asset class. And so, every biases have got some pluses and minuses. I would like to say that equity is one of those asset classes which cannot be ignored today, because considering the kind of inflationary trends we are seeing and the kind of cost push, obviously inflation is seen in almost every odd sector. So equity can only give you the best kind of returns over a longer period of time, because this is a asset class which has always delivered returns after adjusting inflation in mind. On the other hand, if you look at people who have invested in gold or people who have invested in debt or real estate, the biggest problem is liquidity. These are largely hard assets where liquidity is very difficult, and returns from gold and basically from the debt mutual funds are typically only to preserve your capital. They don't allow you to grow your capital, and they are not growth enablers. So equity is only the asset class which helps you to grow your your asset your capital in a very strong manner. And most importantly, it helps you also to get better returns net adjusted of inflation. So I think everybody has their biases, but we have been seeing that what has happened in the last, say, 3 to 4 years, a several amount of people who used to invest in fixed deposits in mutual funds, especially on the debt side, have come and started investing in equity, because now returns from these asset classes have been very minimal. So obviously equity offers a better opportunity, and that's the reason you are seeing many investors now coming and putting money in equities. So biases obviously would continue to be there, but definitely I think equity would continue to be definitely be a prized asset class if somebody wants to take a long term horizon, and that cannot be ignored in today's environment.
Oh, absolutely. And that's in fact the aim of Grow Your Wealth, to help educate all of these investors who are entering the financial markets. So, Avinash, is there a method in which one can identify that, the individual is falling into one of those behavioral traps? And according to you, what's the best way to avoid falling into such traps?
See, I think the best way to avoid behavioral traps is basically do your homework on your own initially. I think with whatever data points you have, because I think today, if you get a broker tape or if you get a recommendation from a friend, there will be a little amount of bias attached to it. So I think it's always necessary that if you want to put your hard-earned money in equity, then some amount of reading and some amount of homework on that particular company is essential. And secondly, as I mentioned to you, that try to fix a goal, a financial goal by which a minimum amount of an SIP is either diverted into a mutual fund investment or a direct equity investment. Normally, financial goal setting helps you to put a little bit of discipline in your financial journey. And most importantly, try to understand that equities will always give you a better return over the next, say, 5 to 10 years. So don't be in a hurry to generate wealth. Wealth creation will happen provided the process is right. So I would believe that start as early as possible, and I think that is the biggest plus point if you talk about a behavioral bias. If you start early, you have a very long runway for growth, and that is the most important thing. Rather than starting in your mid 30s or mid 40s, it's always better to start your investment journey in your mid 20s, because you get a real long runway to generate a lot of capital appreciation for your investment portfolio. And finally, I think always have a balanced asset allocation. Don't depend on one asset class only. Equities are good, but they are volatile. So you must have a balanced asset portfolio consisting of equity, debt, real estate, gold, and try to actually maximize from all these asset classes over the longer term. But nevertheless, equity should be a part of your portfolio. It cannot be ignored.
Patience, discipline, these are just some of the traits required to be a successful investor, and of course, to help you overcome the usual biases and behavioral traps. Now, Avinash, let's talk about then, to put it in numbers, just to be more convincing to our viewers, what is the potential money that could be lost if investors only choose the safer assets like fixed deposits, like gold over equities, due to the risk of, or rather being a little more averse to risk?
See, I think clearly, now interest rates are rising, but they're not going to rise so fast that they would outperform equities in the longer term. My sense is that whenever you buy a fixed deposit or you buy a debt fund, I think please understand that in a country like India, the real inflation is at least 10% per annum. So anything you buy has to be net of, the current inflation which is prevailing around. So typically, if you invest in an asset which is not going to even generate returns after considering inflation every year, that means that actually you are incurring losses every year. Just to give you a simple example, if inflation is 10% and you get 7% in fixed deposits, so naturally, the net result is that you are making a negative return on your investment, which you may not realize immediately. But over a period of, say, 5 to 10 years, you will not be able to build your capital and you will not be able to grow that money. in the way you would like to. So I think, these are the typical mistakes and the kind of negatives which I think one should avoid when one looks at, lower end, debt instruments like fixed deposits or term deposits, which are very simple for people to understand, but unfortunately they are not remunerative and attractive. A better way is to get into some sort of a liquid fund, or maybe a FMP, if you want steady, debt returns. But definitely these would be better compared to a fixed deposit or a term deposits where the rates are not going to cover even the inflation. So I think, these points have to be kept in mind, Mubina, when you structure asset allocation for any investor. A reasonable amount of debt, a reasonable amount of equity, and a reasonable amount of other hard assets, can do the trick. But I think it's going to be over a longer period of time. Any asset allocation does not happen overnight. It takes a reasonably long period.
Fundamental and technical analysis, of course, are important tools to be a successful investor. But I think one of the most important tools is understanding your own biases and overcoming them to really come out as an investor that is able to make the most of the financial markets. Avinash, thank you so much for joining us on what's yet another very informative session of Grow Your Wealth. With that, we'll wrap it up. Thank you so much for tuning in.